Silver crossed $100 per ounce in Shanghai. Not on a small exchange, not in some illiquid after-hours session, but on the Shanghai Futures Exchange, the biggest metals exchange in Asia. It opened up almost 13% at 22,634 yuan per kilo, converting to $102.08 per ounce. A billion-dollar futures exchange had been dark for 7 straight days during Chinese New Year. During that week, silver moved from around $80 to $88 internationally. China's recyclers started paying $96 for scrap. Trump escalated the trade war, the EU froze their trade deal, and Comex kept draining. And Chinese traders sat on the sideline watching all of it unfold without being able to do anything. When the Shanghai Exchange finally reopened, they acted with violence. 13% in a single session is not normal. That is a market coiled like a spring for a week that just exploded. There is some confusion around the number because silver is technically trading at 2 different prices right now. The international spot price that most people follow is still in the high 80s, reflecting the London and New York benchmarks. Shanghai is trading at a massive premium to the rest of the world, and that premium is the most important signal in the entire silver market today. When Shanghai trades 10 to 15% above international spot, it means one thing. China is desperate for physical silver. They need it more than anyone else. They are willing to pay more than anyone else, and they cannot get enough of it from the international market because their own government restricted exports back in January. So the price inside China has to climb higher to attract whatever metal is still available. A 14% premium over spot for physical metal in the world's second largest economy is not just a premium. It is a structural crack in the global silver market, and cracks like this do not close, but widen. The implications of this gap are immediate and mechanical. If you are a silver refiner or trader anywhere in the world, and you see Shanghai paying $102 while London pays $88, you ship everything east. Every available ounce flows toward the highest bidder, leaving less silver available in London, less in New York, and less in the Comex vaults that are already draining at an alarming rate. The Shanghai premium acts like a vacuum, sucking physical metal out of every other market on the planet. When the Shanghai premium gets above 8 to 10%, every physical dealer on the planet starts redirecting inventory. London contracts get ignored, and Comex obligations get deprioritized. Metal goes where the price is highest, and right now, Shanghai is paying 14% more than anyone else. That is not a premium, but gravitational pull dragging every free ounce of silver on Earth toward China. There is a number buried in the Comex data that should terrify anyone shorting silver right now. The managed money long position in Comex silver currently sits at 12,121 contracts, and that is the lowest managed money long position in 20 years. To put that in perspective, when silver was trading at $11 back in 2006, there were more speculators betting on silver going up than there are right now at $88. More people were long silver at $11 than at $88, and that sentence deserves a second reading. The entire move from $30 to $121 to a crash at $77 and back to $88 happened with essentially zero speculative participation. The hedge funds that chase momentum, the CTAs that buy breakouts, the retail traders that pile in when something trends on social media, none of them are in this trade. The rally was driven entirely by physical demand, industrial buying, and central bank accumulation, while the hot money has not even showed up yet. The question that keeps running through every analyst's mind is simple. What happens when the speculators finally arrive? What happens when silver crosses $100 on the international spot price, and suddenly every Bloomberg terminal is flashing the number? When CNBC runs a segment on it? When Reddit picks it up? When the same momentum chasers who piled into GameStop, Bitcoin, and Nvidia decide that silver is the trade? Where does the price go when 50,000 contracts of managed money longs pile on top of a market that is already at $100 with only 12,000 contracts? The direction is violent to the upside. In 2011, when silver ran to $49, managed money longs peaked near 100,000 contracts. That last push from 30 to 49 was almost entirely driven by speculative buying, as specs piled in and turned a rally into a mania. Right now, the market sits at 12,000 contracts, with silver at $88. If specs take this to even 50,000 contracts, that is 38,000 new contracts of buying. Each contract represents 5,000 ounces, meaning 190 million ounces of new paper demand, hitting a market that can barely handle the physical demand it already has. At 100,000 contracts, the math reaches 440 million ounces, more than the entire Comex inventory. The numbers become absurd very quickly. The iShares Silver Trust, the biggest silver ETF in the world, currently has 10 million shares available for short sellers to borrow at a fee of just 0.55%. It costs almost nothing to short silver right now through SLV. But the question is, who has the courage to do it when Shanghai is at $102? The physical market is tighter than it has been in years. There are no speculative buyers left to squeeze out. China has reclassified silver as a strategic metal, and you can borrow shares for 0.5% to bet against all of that. The data suggests the shorts already know they are beaten. Those 10 million shares available to borrow mean that short sellers have been covering, buying back their positions, and stepping away. Earlier in the rally, borrow fees were higher and availability was lower because shorts were loaded up. Now availability is high and fees are at rock bottom. They looked at the tape and decided they were done fighting it. Comex is where this story becomes dangerous. March open interest as of Friday stood at 44,542 contracts, representing 223 million ounces of silver exposure, with only 3 trading days until first notice day. Even if 70% roll to May or later, the remaining 30% represents 67 million ounces of potential delivery demand, and the registered inventory at Comex simply cannot handle another month like January at these levels. May open interest has now surpassed March, sitting at 56,147 contracts after rising 5,066 in a single session on Friday. People are not rolling out of silver and walking away. They are rolling from March into May, extending their bets because the market expects this rally to continue through the spring. If people were bearish, they would be liquidating entirely, not shifting into later months. The roll from March to May is a vote of confidence. Friday's Comex depository report tells the rest of the story. Comex warehouses lost 2.253 million ounces of silver in a single day. JP Morgan's vault lost 963,000 ounces, almost a million from a single bank in a single day. HSBC lost 627,000, Delaware Depository lost 500,000, and CNT lost 162,000. 4 vaults, all draining, same direction, same day. The JP Morgan number deserves special attention. This is the same bank that took delivery of 8.1 million ounces in January, through 1,600 contracts, making them the biggest buyer in the biggest delivery month of the year. Now they are pulling almost 1 million ounces a day out of their own Comex vault. They took delivery in January, stored it in the Comex vault, and now they are moving it out. Where it goes is unknown. Private storage, client delivery, international shipment. But it is leaving Comex, and in this environment, metal that leaves does not come back. Total remaining inventory dropped to 364 million ounces. If March deliveries match January's pace of 33 million ounces leaving in a single week, Comex registered inventory could drop below 330 million by mid-March, the lowest level in years. Every ounce that leaves the vault is an ounce that can no longer back a paper contract. At some point, the math breaks and price discovery moves from the paper market to the physical market. The physical market is already pricing silver above $100. There is a connection forming between Shanghai and Comex that nobody is talking about. Shanghai is paying $102, while Comex has 223 million ounces of open interest in March alone, with first notice day 3 days away. When the people holding those March contracts wake up and see Shanghai at $102, the calculation is simple. Take delivery on Comex at $88, ship it to Shanghai at $102, pocket $14 per ounce. On a 5,000-ounce contract, that is $70,000 of profit per contract just by taking delivery and redirecting the metal east. Even a small percentage of contract holders standing for delivery creates a problem that Comex has never faced at these price levels. That problem has a name. It is called a delivery squeeze, and it may be forming in real time. Silver above $100 in the physical market changes more than the price. It changes the entire narrative around this metal. For 50 years, silver was the forgotten metal, the little brother of gold. Financial media barely covered it, and fund managers did not own it. The public thought of it as something their grandmother collected in spoons and tea sets. Spot hit $121 in January, but that was a spike that crashed back to $77 in a week. What Shanghai is saying now is different. This is the physical market confirming that silver is worth $100 after the crash. That is not a spike, but a floor. When the physical market sets a floor above $100, it becomes the biggest commodity story of the decade. Front page of every financial newspaper, lead segment on every business news channel, and suddenly every portfolio manager in the world has to answer one question from their clients. Why don't we own silver? Coverage brings buyers, buyers push price, Higher price brings more coverage, and more coverage brings more buyers. It is the same feedback loop that drove Bitcoin and uranium, except silver has something neither of those had: a physical shortage that gets worse with every dollar higher. For industrial users, $100 silver is a crisis. Solar panel manufacturers need silver for every single panel, with no substitute available at scale. Their input costs tripled in a year, and they still have to buy because the alternative is shutting down production lines. That is why the Chinese market just priced silver above $100. These companies are not buying because they want to, but because they have to, bidding against each other for a shrinking pool of metal. Government subsidies and renewable energy mandates that cannot be reversed overnight have locked in the demand regardless of price. For miners, $100 silver is the greatest windfall in modern history. Mines that were marginal at $30 are printing money at $88, and at $100, they become cash machines. But mining companies cannot increase production overnight. New mines take 7 to 10 years to permit and build, while existing mines are already running at full capacity. The supply response that is supposed to cool down the price does not arrive for years. Samsung has already locked up entire mine outputs, and other major tech firms are reportedly doing the same. The silver coming out of the earth is spoken for before it hits the open market. Silver at $102 in the Chinese market does not mean international spot hits $100 tomorrow. There is a lag, where Shanghai leads and international follows. The expectation is that spot pushes toward $90 to $92 this week, and if it breaks $92 and holds, $100 by early March becomes realistic. But timing is uncertain, even when direction is clear. An Iran deal, trade de-escalation, or a Comex margin hike could trigger a short-term pullback. Silver dropped $40 last month, from $117 to $77 in a single week, then came right back within weeks because the physical shortage is structural. It does not disappear because of a headline or a margin hike. Pullbacks in this environment are buying opportunities, not exits. The $14 gap between Shanghai and international spot could narrow if metal flows east fast enough. But China's export restrictions prevent the reverse flow. Metal goes into China and barely gets out, so the pressure stays one-directional. If that gap holds above $10 over the next 3 days, the international price has to catch up because there is no other resolution. In every silver rally of the last 2 decades, there is a phase where positioning transitions from dead quiet to full mania. In 2011, it went from 20,000 to 100,000 contracts in about 4 months, adding 5,000 contracts per week of pure speculative buying, each week pushing 25 million ounces of demand into a system that was already short. And that happened with silver below $50, when nobody on financial television was discussing it. Now imagine that same transition happening with silver already at $100, with every financial headline screaming about it, with retail investors who missed Bitcoin and Nvidia looking for the next move. The transition from 12,000 to 80,000 contracts this time will not take 4 months, but weeks. And when 300 million ounces of new demand hits a market that can barely deliver what has already been promised, the result is not a rally, but a detonation. Shanghai opened today and told the rest of the world that the crash was a lie. Silver is not worth $88 because the physical market is saying $102. Once the rest of the world catches up to what Shanghai is telling us, once the speculators arrive and once the media starts covering this story, the day the physical market took control of the price may be the day the forgotten metal became the most important trade on the planet.